What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is January 18th of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I want to spend some time to talk about a major dynamic that's been benefiting stocks that could start to falter going into the next year, and that is going to have major ramifications for what happens to Bitcoin's price going forward, as there's been a pretty strong correlation between the two markets. We've got a lot of things to dive into today's video. If you happen to like it, drop a like. It's one of the greatest ways you can support the channel. And let's go ahead and kick off the rambling. All right, so I want to go ahead and start off here by just doing our typical Bitcoin analysis here, talking about some interesting dynamics that I'm noticing at the moment. First off, we've got a bit of a stagnation and momentum here over the past couple of trading days, and nonetheless, we are above that 200-day moving average. And while that is definitely a really interesting sign here to potentially signaling that we maybe found our bottom, as some people are calling for, as a lot of the original data science models may be able to make the case for, it's the first step of many to be able to confirm that we're in an uptrend, a sustainable uptrend. This is the first time since back in March of 2020 that we've actually gotten above that 200-day moving average or tested against it, and it's the first time again since back in December of 2021, nearly a year ago, since we've gotten above that measurement. And the question is whether or not since then are we going to be able to turn those moving averages into new support, or is this yet again going to be another short-term deviation that thereby leads towards more corrections lower with potentially more relief rallies, which this may be very well. Now I want to go ahead and again emphasize as well the percentage increase, and not to mention a very similar time frame at that. We've had a 46% relief rally, 43% back between June to August, and since November here towards January, we had a 40% move in Bitcoin's price. Now this is getting to the typical percentage increase that we got during relief rallies. And again, I just want to signal that caution, not to mention with how overbought we are at the moment. This is the highest we've gotten overbought on Bitcoin's price since as far back as January 10th of 2021. Think about that here. In over 2 years, the biggest overbought signal we've seen. Now, again, that could be an argument made for the bulls here that we're actually starting to set up for the next move, that we're starting the next bull market. Again, I'm not negating that as something that's totally positive or totally negative, right? I think if anything, we should expect some kind of cool down here in the near term, but that doesn't mean it can't be a longer term foundational sign that we're ready to move higher. The big thing I want to talk about though, again, and why I keep emphasizing the 200-day moving average is because of the fact that when we clear through that 200-day, once we've had our bear market bottom, even though again, it is at a slight premium here, again, we are not here to try to pick bottoms. What we want to see is when the trend is really starting, because no matter if you got Bitcoin exactly at the lows, which only a few traders got at 3,200, or you bought it here at say 5,000, when you can start to see that price gets above that 200-day, which was serving as resistance, and is able to maintain above it, you can capture Bitcoin before the trend really kicks off. You can still make great returns on these plays. And it didn't just do that in the last bear market in 2018, 2019. It also did that in previous bear markets, right? We got over the 200-day. We weren't able to hold on that 200-day, and we flashed down to new lows, lower than where we were back in January 2015. Nearly an entire year later, and 9 months later, we set a new bear market lows. So again, even if we're kind of in that sideways accumulation channel like we did back in 2015, maybe that's how it's playing out, we want to wait until we really see that we're above that 200-day and that the market is ready to move higher, or buy in that capitulation, right? So we don't want to be buying into some kind of rally like this unless we're really going to see the foundational signs that it's ready to sustain itself. Okay, so that's the Bitcoin analysis. And on top of that, just to kind of close that off, we can also take a look at Bookmap as well. Multibook had a little bit of downtime here between January 15th and 16th, so the data isn't entirely complete here. But what's really interesting is as we've gone into these later part of the week, as we've started to go into the new week, and over the last 7 days start to account for that more kind of stagnant price action, as we've seen relatively in price, that market order flow has gotten a bit weaker across Binance, Huobi, and some of the major exchanges out there. So again, on the spot market, we're not seeing the kind of sustained buying that's really going to drive price higher in the long run. But we definitely do have some more bid support here at levels like 20,000. But we're going to have to continue to see how things play out into the coming months. The big thing, again, if you guys are interested in trying to get that extra insight or data beyond just analyzing price, I definitely recommend you guys check out Bookmap down below in the description. It's a really exciting tool, one of the few tools that we use outside of our typical price analysis to try to get understanding of the market structure under price. There's a link down below in the description if you guys want to get check it out and get 20% off your first month. But let's go ahead and dive into the bigger topic here. I want to go ahead and really try to understand what's going on behind the scenes right now, because really over the past couple months, equities have kind of held out at the valuation range they're at now. We've seen crypto starting to show some signs of optimism. What's really going on here, right? We obviously don't have a positive economic outlook. Some people have maybe hinted towards a talk of a soft landing, as has been rumored by many people. But the key thing I want to go ahead and talk about is why prices are holding up. Because put aside all the headlines, our projections for the future, one of the big dynamics that I really believe in, I've learned in over the past couple of years, that most investors, I would say, either don't really believe in or even really consider or understand fully, is that markets here today, the price of a given asset is going to be determined by inflows, outflows. Now, those inflows and outflows can be changed by perception of where equities or assets are going to go in the long term. It can change depending on the future economic outlook, all kinds of different things, or what people project the Fed might do. But generally speaking, at the end of the day, do we have more buyers or more sellers? If we consecutively, on a week by week, day by day, month by month basis, no matter what time frame you're looking at, if we're having more sellers than buyers, there's no reason to chase the trade. There's no clear sign of a trend reversal. Market outflows are outpacing against market inflows. But I would say over the past couple months, as we can see in price, since May, we've probably had relatively neutral inflows and outflows here, right? So what's really going on here, right? Because when we take a look at some of the major data points out there, if you take a look at fund management, if you look at, for example, people who are managing pensions, there's been some pretty big outflows of equities on some of those positions. So what's really going on here? Well, what's going on here is that you've got not central bank liquidity from the United States. That's not helping. As we emphasized before, the Fed, in this past month, they reduced their balance sheet by over $138 billion. And that's at an accelerated pace from the previous months where we had around $70 billion removed from the balance sheet. So not just stopping quantitative easing, but quantitative tightening, the counter opposite. So that's not helping equity prices out. What else could it be? Well, there is one thing that doesn't get talked about enough. There are really two dynamics here that we have to talk about. First off, we need to understand the concept of global central bank liquidity. We in the United States tend to be a little bit isolated sometimes. We tend to think that we are at the center of the world. The United States does have a massive set of ramifications on global economic performance, depending on what the United States is doing, where consumers are in the US, for sure. This plays a huge dynamic in things. But we also need to get out of our bubble sometimes and realize that there are other central banks across the world. And to understand that liquidity from these central banks, albeit maybe not so much in China, can become global in the way that they go to different economies, right? So generally speaking, over the last decade, from back in 2008, 2018, going into even the later blow-off stage here during the pandemic, we had a massive injection of liquidity into the economic system. And now we've been seeing the Federal Reserve as well as the ECB, the European Central Bank, continuing to tighten their monetary policy over the past year. However, since back in December here, we're seeing a major push higher for Japan and China. And this is a really important thing we need to understand here. Sure, in China, this is probably going to be benefiting more specifically Asian indices, for example, the Hang Seng Index and some of the big Chinese companies like Alibaba, as well as JD, which we've talked about before on the channel. But with the Bank of Japan stimulating like this is also going to allow for liquidity not just to support Japanese stocks, but it's going to be supporting U.S. equities. This money can flow globally. It can go wherever it is best desired to go, where it's going to be expecting the best returns. And that, again, has definitely been partially a cushion against that tightening of central bank monetary policy. Generally speaking, to just kind of visualize it in a different way, there's the aggregate of the major central bank assets. And we can see between the Fed, ECB, Bank of Japan, and People's Bank of China, we actually expanded the money supply in Q4, not contracting it. So this whole talk of, oh, we're really tightening, we're really starting to, combat inflation, and we're doing the right thing. Point here is that we're not doing enough. If we really want to get inflation down, we do it aggressively. We understand that, there's going to be possibly a recession along the way, that we might break something along the way, but it makes sure that we're going to be able to cool down that central bank liquidity, the monetary stimulus that led to the monetary phenomena of inflation. And I think the Fed is not doing enough here. If we are starting to revert course here, if the Fed stops tightening and we see our Asian counterparts continuing to stimulate as they're trying to reopen their economies from a more longer-term lockdown period or stringent COVID policies that they had, which unfortunately they kept for way too long, in my opinion. I think at this point it's really not up for debate. China has done a complete 180. It was a complete mismanagement, and case numbers, of course, still exploded either way, right? So again, put aside the political discussion around that. The central bank monetary policy that they've taken on is going to be rapidly inflationary, considering that it's going to take time to get the economy back to where it was. Now, this is just one thing here, but the big thing I want to talk about is really what's going on with stock buybacks and dividends. I mean, I got to tell you guys, this is one of the most criminal things I think we've seen in our history. While, of course, a lot of companies are going out and laying off employees, are starting to cut back majorly on their expenses and operations. On the other hand, we're starting to see stock buybacks at a record level, right? We're continuing to still hold out to the levels we saw in 2022, or at least off of the Q3 and Q4 data we had. 2022 was one of the biggest years on record for stock buybacks alongside 2021, as companies have record levels of cash from the past few years and increased consumer spending. However, as we have had incredible amounts of stock buybacks where companies are spending literally corporate cash to buy up their own equities and other types of assets, and we also have the S&P 500 coming in and providing the highest levels of dividends it has ever paid in history for the past 4 quarters. We need to ask ourselves whether or not this can sustain itself. Can we still see such a high rate of dividends going to investors? Will we continue to see such a high rate of stock buybacks going on in equity markets? And I got to be honest with you guys, I don't think that's going to be the case. This is where the pedal meets the metal, where the real economy really does have an effect when it comes to equity markets and their performance. It's one of the few fundamental things. While I don't like stock buybacks, dividends and stock buybacks do play that integral role, whereas if corporate earnings are weak, then we are going to expect further downside for equities due to the inability to take on such lucrative stock buybacks. You can see this, for example, in 2007, 2008. Stock buybacks went from a record at the time of $650 billion on an annualized time frame down towards just a couple $10 billion. So this does have some kind of effect when it comes to the overall performance of equities, and it will have an effect on crypto. Do not doubt it. If global equities are in a major outflow, if we're going into a recession and equity valuations start to go down towards lower levels and we continue having lower highs and lower lows, which signify a downtrend, it will likely have the same effect on crypto. Until we see a break in that correlation, we got to think in that mindset. And this is a big thing, guys. To be going from around $1 trillion in stock buybacks on an annualized basis with some of the record corporate earnings that we had in 2021, going into an environment that's recessionary, where still estimations are quite high for the next year. This number really starts to put things into perspective. In a November note by Goldman Sachs, strategists led by David Kostin forecasted buybacks to fall 10% in 2023. In this case, meaning around $100 billion of liquidity at current rates. In the event when the economy falls into a real recession, the team predicted buybacks would drop by 40%. That is $400 billion of bid and market order flow support that's been holding up prices like we've seen since May, that will not be able to come in to support some of the leading technology stocks like Apple, leading technology plays like Meta, all kinds of different companies out there that have had relatively strong corporate earnings and growth over the last decade. So growth estimations are weaker than ever for these tech companies. They're looking like they're entering in towards their dinosaur phase or the late stage of the business cycle. They don't have the same kind of corporate earnings that they used to have because we're entering into a recession, therefore weaker stock buybacks. And last but not least, the Fed is tightening liquidity. All three of these things are major negatives for the future output of equities. Plain and simple. It is monetary inflows and outflows. And trust me, when I say this, guys, we are already starting to see the worst play out here. Large technology companies that, again, are very cash rich, like Microsoft, have laid off over 10,000 employees here just as of yesterday. Major announcements from Salesforce, Microsoft, all the big companies that you usually think would just be able to stomach this, have the cash, are going to continue operating as is to try to get ahead of the competition. They're starting to tighten their belt and contract their economic activity. Now, again, just to visualize this again, we have to ask ourselves whether or not we can continue to have these kind of stock buybacks. And if we can't, as we've seen in 2008 and 2009, when those stock buybacks dry up and we get hundreds of billions of dollars less in liquidity injected into those stock buybacks, we get weaker dividends, which give less incentive for people to own shares in companies. We got to be prepared for what that's going to do, not just to equity prices, but on top of that, what it's going to do for crypto. And I got to be honest with you guys, as that liquidity is drying up, as there's less excess money, and the winners that people used to depend on in their portfolios make additional returns and reinvested, when those start to be underperformers, as they have been in 2022, this is the definitive starting point for a recessionary bear market that plays out not just over, say, a couple months and declines anywhere from 15 to 30%, but one that is going to take us down 50% or more. And that's what we got to be prepared for. If you guys are fully in assets right now, right, and don't have any cash on the sidelines, and can't stomach going down to new lows, or potentially even worse, really having a real recessionary bear market, you might be overexposed. And that's why we've been in cash right now, right? We're really trying to prepare ourselves, setting high standards, and we will happily pay a slight premium on Bitcoin. We got out at around 24, 25K. Still got a ways to go before it gets back up there. And we'll let you guys know if we make that decision, if we really start to go long on the market or start to get optimistic. But there's a lot of key things that are setting back markets now. Not to mention, a really interesting metric that came out today, just to kind of close off on an interesting note. China saw the first population decline since 1961. Starting to visualize China's major growing demographic issues that are going to have serious ramifications. This has been a huge weight on the booming housing market of the last decade in China, not to mention you mix in Evergrande and all the scams that went on there. I mean, if we're really considering demographics here, China is in a major issue. China's been a huge element of growth over the past decade as it's continued to expand into its middle class, be able to service the global economy. Now there's going to not be the same amount of labor to be able to produce the goods and services that we're used to over the last decade, or at least the growth in that as we continue to globalize across the world. We're going to need new market leaders, new countries, new economies that can start to meet towards that demand as the global population expands still. So this is a really interesting thing. Again, I'm definitely no expert in this regard, but the big thing I want to emphasize is that this is going to be a continuously growing problem here for the global economy, lowering consumer demand in the long term. And again, maybe that cools inflation. That's great. That's step number one. And the Fed is very much on its way. If it sticks course, if it does the right thing, we are on our way towards getting rid of inflation back to the original 2% levels. But what we may not be ready to stomach, and what equity prices are certainly not pricing in, is a potential recession. I think we're living in la la land if the Fed can really just start to completely revert course. It hasn't completed the job just yet. It needs to get down to 2%, and it needs to stay there for a prolonged period of time before it can really start to ease or start to stop quantitative tightening. So anyways, guys, that's it for today's video. Thank you all so much for watching. If you enjoyed my rambling, drop a like, consider subscribing if you haven't already. Join the DataDash family. Again, if you guys agree or disagree, it's totally fine. It's all about having a conversation. You're just trying to share my perspective on things, and more than anything, trying to be as realistic as we possibly can be. The best investors don't focus on what you can make on an investment. They focus on how much you can lose with any investment and how far things can go down. You always have to preserve and protect your capital, especially during recessionary and bear market periods. So anyways, guys, have a wonderful rest of your day. Trade safe, stay smart, and I'll see you guys in the next video. Take care, everyone.